For today's session, we have invited Scott Hartz to talk about the investment landscape for life insurance companies and the main challenges in a pandemic and a post-pandemic world. As Manulife Financial Corporation Chief Investment Officer, Scott oversees approximately $427 billion in US, Canadian, and Asian general account investments. Scott is also the Chief Investment Officer for John Hancock Life Insurance Company in the US. Scott graduated from Colby College with a BA in Physics and Economics, and he's also a Chartered Financial Analyst and a Fellow of the Society of Actuaries. I would say, Scott, that is a killing combination. Scott started his career in John Hancock in 1983, which was acquired by Manulife in 2004. So Scott has been now almost 40 years with Manulife in one form or another. Scott's investment group manages a global portfolio composed of roughly 85% fixed income investments and 15% non-fixed income investments. In addition to investing in traditional asset classes, the group underwrites and originates private placement debt and commercial and agricultural mortgages within fixed income, while originating and managing commercial real estate, timber, agriculture, infrastructure, oil and gas, private equity, and mezzanine investments. Welcome, Scott.
Thank you, Marcos. Great to be here.
As a reminder to the audience, please type your questions in the website, in the application, so that we can answer them towards the end of this session. Well, Scott, I think we can begin by discussing Manulife's strong investment performance in 2021. You just released earnings last week. Results were really, really strong in terms of profitability and how you have navigated the pandemic wave. So I would like to know more about what has worked and what has not worked for the company from an investment perspective, of course, since the beginning of the pandemic.
Sure. Yeah, it's been an interesting 2 years, to say the least. And I guess I'd start by saying, our approach to the bond markets lending money is we put a lot of resources behind it. We take credit analysis very seriously. We leverage off the good work that DBRS, Morningstar, and other rating agencies do, but we also form our own opinions, and that's based on a couple of factors. One, we've been doing this for a long time, 50 plus years, and really, if you go back 20 plus years, most of our lending was really done in the private markets. We would make loans to private companies through private placements, and there we didn't have the benefit of rating agency ratings, and we didn't have the benefit of liquidity. So doing deep fundamental research, expecting you make a loan and you're going to hold it till the end was super important to us. A second factor there, I would say, is there's just our time horizon. As a life insurance company, our liabilities run out 30, 40, 50 years. And so to match our assets against those liabilities, we make very long-term loans, 30-year corporate loans, and even longer when they are available. And so when we analyze a credit, we're anticipating, how is that going to perform, not through the next earnings cycle, but really over decades, frankly. And so I think that mentality has served us really well in all sorts of environments. And the pandemic was just, a more recent disruption. And so, yes, as you point out, when the pandemic first hit, we tried to project out what would happen in our portfolio, and we projected out much worse results than we ultimately saw. I think in 2020, the first year, our credit results, the way they're measured in our accounting system, were a slight loss, and that means they were a little bit higher than what we would have priced for in our liabilities. And then this past year, there was a large gain. Whatever losses we took had been reversed, and we, took very little losses. So relative to what we priced for, the results were really quite good. And, part of that is, again, I think we do a good job with fundamental credit analysis, but it wasn't really, as I said, what we expected going into the pandemic. And what we saw was, just incredible government support, which, we, in our analysis, we don't factor in government support so much in North America. We certainly do in certain Asian countries where we do a lot of business. But you saw sort of unprecedented moves by both central banks, in terms of not only what they did with interest rates, but setting up facilities to buy corporate debt. Don't think they ended up using those, but just having those available gave the market a lot of confidence. And then the fiscal support was, again, unprecedented in the size that came through, and that was all, very supportive of a recovery. And so, through these 2 years, on average, our credit results have been quite good.
Scott, I mean, in our insurance rated universe, we have seen companies performing pretty well in terms of their investment portfolios after the initial hit, let's say the first quarter or two, maybe three during the pandemic, and then the investments have actually performed pretty strong. But in the case of Manulife, we noticed that you have experienced losses for the first 3 quarters of the pandemic, and then basically you have booked net gains, including $100 million in Q4 of last year. So what is your outlook in terms of those experience gains going forward in the investment portfolio?
Yeah, as I mentioned, the way the accounting works for us, the gains, if our credit experience, i.e. losses, and that's a combination of if you have impairments or you have downgrades. A downgrade creates a charge for us, as you know. If that equals sort of our long-term expectation, which is based on many years of history on average, then we call that zero credit experience. And if we have fewer losses than that, then it's positive credit experience. And you referenced the 100 million of gains we had in the fourth quarter. That was a combination of basically no credit losses plus a lot of upgrades. So 100 million, I think maybe the largest quarter we've ever had in terms of credit experience. I think the prior quarters were maybe around the $40-50 million positive range, and that's normally what I expect in a benign credit environment. That's kind of we're having, very little in the way of downgrades and pretty much no write-downs. You can always get some idiosyncratic downgrades that happen, although we haven't seen much of those recently. So as I look forward to this year, this is going to be a very interesting year. I think we're starting out in a good place, but the central banks are needing to do something about inflation here, and there's a lot of geopolitical risks which we could talk about, but there always seem to be a lot of geopolitical risks. To me, the big risk that's facing us is the central banks, making a mistake in here, because it's a very difficult environment for them to navigate. They've got to do something about inflation, but if they move too quickly, tip us into recession, and then with a recession naturally comes credit losses. So we will see. I think for sure the first half of the year will be good, and then we'll just have to see how the environment develops after that.
And Scott, for our audience, when you mention upgrades and downgrades and the impact on the credit experience, are you talking about, and this is for our audience, of credit upgrades or downgrades driven by rating agencies or by your internal credit team, or both?
It's both. The way our accounting system works, which in Canada is fairly unique, and actually I really like this part of the accounting system. As you mentioned, I worked at John Hancock for a long time, and I dealt with U.S. accounting rules. And in the U.S., if you have a triple B bond gets downgraded to double B, you have to hold a little more capital for that, but there's no impact on your current period earnings. Whereas in the Canadian system, you have to say, my expectation of losses has gone up, and you have to present value back the higher expectation of losses in the future. So you take a charge due to downgrades. So yes, it's credit upgrades and downgrades impact our earnings.
And in terms of your investment philosophy and strategy, so the success of the investment portfolio during this pandemic this investment strategy and philosophy has remained the same, or your team has adjusted that philosophy in the last 2 years?
I would say it's remained the same. I mean, again, our time horizon is very long, and we've been through, and we have very seasoned people in there. You mentioned I've been there nearly 40 years, with most of that in the investment group. And, one thing I love about where I work is that I work with colleagues who have worked there a long time. And, so you get to know each other very well, communication's very efficient, et cetera. But as a consequence, we've all been through a number of cycles, the early 90s, the early 2000s, the GFC, and now the pandemic. And, you learn from each of those experiences for sure. But was there anything unique about this cycle? I would say the one thing we debate, I don't think we have a consensus around, is what I did find unusual was the amount of government support that came in, and particularly on the fiscal side. And there's debate that that's part of what's potentially causing inflation now, but there just seems to be a little less political will for recessions these days. And so should we expect going forward that we're going to see more government support than we used to? And is that going to make credit losses? As I said, when we look at our credit experience, we look at like the last 30 years of history, and is the next 30 years of history going to be the same as the last 30 years, or is there frankly, we're going to see more government support than we have in the last 30 years? I mentioned in Asia, when we're evaluating credit risk, we often need to take more government support into consideration when doing the ratings. We certainly haven't gone there yet. We haven't reflected that in our ratings in North American companies, but it is something that I just felt different in this cycle, and whether that's going to continue or not is a bit yet to be seen.
And thinking about the future, so let's say in a 5 years time horizon, and besides the fiscal help received from governments around the world, do you see any other structural changes in the economy as a result of the pandemic that will require different portfolio locations going forward?
I guess inflation is a big question. How much of the inflation is due to the pandemic? Some of it maybe is due to the government actions. Some of it's due to supply chain disruptions. But regardless of what started it, sometimes inflation gets rolling, and it's hard to stop it. Now, so we spend time thinking about that. If inflation is going to be higher, and I guess my view would be inflation will probably be higher than it's been over the last 10 years. I think the central banks would frankly want inflation to be higher than it was over the last 10 years. The big risk, of course, is that it gets very high, back to the late 70s, if you will, and that can cause a lot of disruption. I think a little bit higher inflation would be a good thing. Certainly for our portfolio, we have a lot of, you mentioned the 15% in non-fixed income. A lot of that's in real assets, and real assets, infrastructure, real estate, timber and ag, that, inflation will be beneficial for those asset classes. So inflation comes with, some difficulties, your own company's expenses and so forth. I feel like on the investment portfolio, it's not so bad, and a little bit higher controlled inflation, I don't think would be a credit negative either. But if the central banks can't get control of inflation, that could be more of a problem. My view would be they can. Like they know how to deal with inflation. They've done it over the decades. It's deflation that we, had been worrying about before the pandemic that is much more difficult for them to deal with. So, but they have to have the political will to do it, because often when you do it, it does, in the short run, creates a drag on the economy.
Yeah, I would like to know your view on the impact of the pandemic on real estate assets, especially office space going forward. I mean, there's a lot of talk about hybrid work environments going forward, not a lot of people going back full time. So what would be the impact on the valuation of real estate assets, particularly in Manulife's portfolio?
Yeah, it's a really good question, one we've been struggling with since the start of this. I think, and in a lot of ways, the pandemic has sort of accelerated trends. It's certainly accelerated the move to digital in so many different ways, and I think the same is true for office real estate, although maybe a little bit more than just accelerating. But if you look at where we were before the pandemic, I think of my own company, I think, probably 30% of the people there work full-time remote as it was, and that was an increasing number. So we were seeing some of that in any case. What the pandemic has done is we've talked about more of a hybrid work environment for those who are intended to be the office, and that was not talked about before the pandemic. So we will likely go that route with sort of 3 days in, 2 days out. For us, again, we're intended to have those 3 days, everyone in the office on the same 3 days. And that does not allow for less space, right? If everyone's, if you spread it out somehow, you could, not have assigned desks and reduce your real estate footprint. I think if everyone's intended to be in, and the reason we do that is because we think that's important for collaboration. Like, there's not much point in being in the office if your colleagues that you need to work with are not there. So, and I think that's the general trend of companies, is to do it that way. So will that lead to a reduction in the amount of leased real estate? I don't think that will so much, but you certainly are seeing some companies going full-time remote for everybody, right? And that was not so much the case before the pandemic. I remember before the pandemic, I think Yahoo had everyone work from home. They decided that didn't work. They called everyone back into the office. And so who knows? I think we're all experimenting. And certainly when we talk to our employees about it, we say, listen, this is what we're going to try. We're going to pivot if it's not working well. So we will see. But so long story short, yeah, it's not great for office real estate. I think it has to put some dampening effect on the demand for office space. The big question is how much, and I don't think it's as much a dampening effect as people might have anticipated. But we will see. What I do think is changing is where people want to work. Like with real estate, they say all real estate is local. So I think we have seen a move of companies to more southern areas, Austin, Nashville, places like that. And you've seen office real estate markets there do very well. Whereas, if you're in New York City, I think some of the newer buildings are doing quite well. Some of the older buildings are struggling. So with real estate, as in most investment categories, everything does not behave the same. And it's important that you be smart about where you have your investments.
Yeah, and in terms of the alternative long duration assets, the ALDA portfolio, where Manulife has a long dated expertise that actually is available for external customers of the group. How do you see the pandemic affecting some of these assets?
Yeah. So real estate is the big one. We've kind of covered that, although we didn't talk about, industrial or warehouse space has just been on a huge tear. And that's, again, the acceleration to digital and remote purchasing, and the rest of it is just the demand for space there is incredible. And that part of the portfolio has done tremendously well, as it has for everybody. And I see that just continuing, and that's been accelerated by the pandemic. Multifamily has done really well as well. There's definitely a housing shortage, so that's done well. So in general, real estate has done quite well through the pandemic, and I think the forecast is bright. I think there are some negative spots, retail, and we don't really have retail in our portfolio. But again, it's real estate is so location specific. Some retail does okay, but on average, I would say retail is obviously having some struggles, as is office. But beyond real estate, I would say if we look across the other categories to kind of tick through them, private equity has done unbelievably well. Obviously, public markets have done well. Private equity has done even better. I don't see those trends reversing much. Timber, I'm sure we'll get into ESG at some point in this conversation, but I'll talk more about timber then, because I think that's a real tailwind to timber. But from a pandemic perspective, I think the desire for people to live a little bit away from the cities, the increase in demand we've seen for housing has been another tailwind for timber. Because timber is an interesting asset category, and over the last 10 years, frankly, hasn't performed very well. What that means is maybe a 6% return, where we would, whereas like private equity's been up in like 15% return. And part of that is since the global financial crisis, which was sort of a real estate housing-led crisis, we haven't seen home building come back as strongly as has been predicted pretty much every year. So we're seeing that trend reverse. You're seeing a huge increase in demand for housing, which leads to a demand for 2x4s, which leads to a demand for logs that you turn into those 2x4s. So timber had a good year last year, and I expect that to continue. And as I said, inflation will be a tailwind for real estate, for timber, for agriculture, and agriculture is another, very specific where you're doing it, but has been a good performer for us. Infrastructure, I would say infrastructure, we've seen, as we have a little bit in real estate, sort of a transition into kind of what assets we're buying these days. It used to be, way back, it was gas-fired power plants. It became more renewable power plants in the last 5 years. I think it's more the more digitally focused infrastructure. So data centers, cell towers, the expansion of 5G leads to needing a lot more cells throughout cities and so forth. And that's all, a form of infrastructure. And so I think that's an exciting time to be in infrastructure. I feel good about that. The last category, oil and gas, is one that, again, we can talk about that with respect to ESG. In the pandemic, we saw oil prices go below zero, which was obviously not good. And now we're back, close to $100 a barrel. So it's been kind of a wild ride. The cyclical movement in that industry is just spectacular, but it's clearly in a long-term secular decline. And so, we have a legacy oil and gas portfolio, but it's been declining. We're not investing in that space. It's done very well this past year and probably will this coming year, what we have left. But, I think it creates good exit points, frankly, for what we do have.
And in terms of the macroeconomic scenario, can you share some of your expectations for inflation and interest rates in Canada and the US for 2022? And complicated with IFRS 17, I guess.
And IFRS 17 will change it all. So, It's something we spend a lot of time on, but my perspective is we want to hedge it as much as possible, hedge the economics and pay attention to accounting and regulatory capital environment to make sure we're being prudent there too. With that said, my view is, I mean, the U.S. 10-year is up around 2% now. It's gone up quite a bit so far this year. I think we've seen the entire yield curve shift up, unlike a year ago when the central banks were pinning short rates at zero and the yield curve was steepening. This time around, rates are rising, but they're rising all along the curve. And I do expect that trend to continue. I don't worry too much about rates getting like super high, because that would create it'll be a drag in the economy, create a recession, and rates will need to fall. But I do expect rates to sort of continue their modest march up, which by and large is good for financial companies generally, insurance companies specifically, and so for us, that would be a good thing. But as I said, you never know, and I think it's a particularly uncertain year because of the expectations about what central banks are going to do, what they actually do. It's fascinating to follow and to speculate on, but bottom line, it's we try to be a hedger of interest rates.
That's right. Thanks. And just to close this section on the macroeconomic environment, it's not a secret that Asia is a key market for Manulife growth prospects. So what are the main investment challenges that you face in the region?
So with Asia, I guess I'll start with, Asia is not one country, right? It's a collection of countries, and each one is a bit different. So it's hard to generalize about Asia, but maybe I would say one of the big challenges for us is how do we get enough appropriate investments for our balance sheets out there? And that will vary on how the capital markets are much less developed in most of those countries. We don't have all the choices we have here in North America. So how do we prudently invest for them? In some countries, they do not allow offshore investing. So you have to invest only in the local markets. And in some local markets, take Vietnam as an example, that's one of our bigger businesses in Vietnam, done extremely well there. And the challenge is, like, how do we get all those premium dollars invested? We have them invested, almost entirely in Vietnamese government bonds, still below investment grade, so they're rated BB. But there's not a well-developed corporate bond market there. It's coming, and we've done some corporate bond investing, but so we're basically investing largely in government bonds, not getting a spread on top of government bonds, but we price our products that way. I would say the other challenge is getting the duration or the length we need on those loans. Fortunately, actually in Vietnam, the government has issued many long bonds, which we do invest in, but we don't have the derivative markets that we have here in North America to extend duration. We use derivatives extensively in North America to try to match our assets and liabilities. We do not have that option in, frankly, most countries in Asia. I would say other countries, take Hong Kong, for example, which is our biggest business in Asia. They do allow offshore investing. So we invest really across the globe, and then we sell both dollar products and Hong Kong dollar products in Hong Kong, and we will, the derivative markets allow us to hedge both those currencies. Even though the Hong Kong dollar is pegged to the U.S. dollar, there is risk it would depeg, and so we try to ensure we have Hong Kong dollar denominated assets, even if it's synthetically done through derivatives. But we really take approach as an investor where we can take offshore investments and put them on the balance sheet, which again, we can do in certain countries in Asia, Japan, Hong Kong, Singapore, for example. We search the globe for value. We invest, some of it we take Canadian mortgages and we put them on our Asian balance sheets. We take Canadian bonds, U.S. mortgages, European bonds, and in Asia there's the Asian dollar bond market, which is where companies in Asia are issuing in U.S. dollars, and they would be considered offshore to any individual country. So if you can do offshore investing, you do it there. China itself does not really allow offshore investing for the China balance sheet. You can in Hong Kong, but not China. Again, we have a decent sized business there and aspirations there. But that is a country where the capital markets, not as developed perhaps as North America, they're pretty well developed. There's a very large corporate bond market there, which we do invest in. And that's an example of a country where there is more government support. A lot of the corporations are state-owned enterprises, so they're at least partially owned by the government. We would expect some government support. So the credit analysis is a little bit different than it is here in North America.
Yeah. So now moving to ESG, everybody's favorite topic these days. So we are aware that Manulife released its climate action plan last year. And this plan includes the company's commitment to achieve net zero finance emissions by 2050 and an operational emission reduction target. Can you go over some of the implications for the general account investments of this climate action plan?
Sure. Yeah, this is a big deal, and it is, when we're analyzing credit risk, as I said, we like to look out decades ahead, and ESG with the E part and carbon and climate being the biggest factor. We do pay attention to the S and the G, the social and the governance as well, and build that into our credit analysis. But really it is climate that has the biggest impact. As you point out, we have made a commitment to get to net zero by 2050 in our investment portfolio. And I think most but not all FIs have gone in that direction, and it's obviously going to be a challenge, and probably relies on technology that doesn't exist now to get there. I think the next step for us is to set a more intermediate term target. You mentioned we've set one on our operations. The carbon we emit from Manulife's operations, not its investment portfolio. We have set a shorter term target. That's something we control. We're in the process of setting one now for our investment portfolio. We're using a nonprofit group called Science Based Target Initiatives, SBTI, and they're helping us. They'll sort of certify the setting of the target, because you want to make sure what you're doing is appropriate and recognized by experts in the field, that it's really moving you to where you want to go. And a lot of that is, as we look at, well, let me step back. There's two things. There's one, trying to get to our commitments, and we're going to set a shorter term commitment and get to that. And then there's also, if we didn't make any commitments at all, this is still a hugely important topic that affects credit risk, right? And that's what we're all about, is evaluating credit risk. Like how, making a 30-year loan to a utility in the Midwest that generates 60% of its power from coal, like that's not a sustainable situation. I would say in that situation, the good news is that that company is likely to decommission its coal over the next 10 years. They would have, about part of our analysis, do they have plans to do that? Can they pass those costs through, which the regulatory environment usually allows them to do? So much of the analysis is what pressure is going to come under this company as the whole world moves in this direction, and either regulatory pressures come on them, or carbon starts to get priced as it is in Canada and Europe, not yet in the US. And by the way, I think, taxing carbon is what makes the most sense. Then the markets can figure out what the most efficient way to reduce it is, but it can be a political challenge to do that. So we look at every company, and if they're not paying attention to what's going on, that's a really bad sign. Or if they're in an industry or a subsector where it's really hard to decarbonize, that's going to increase their cost to do that over time. So you need to reflect that in your assessment of the risk. So I just start by saying, even if we didn't make any commitments on our portfolio, this is a hugely important space that we need to pay attention to. Every credit analyst needs to pay attention to it, and I think by and large, people are generally. So it's a very real thing. With that said, we also at the same time have to reach these commitments, but working with Science-Based Target Initiative, I think what I feel good about is it's not so much, how much, these are called scope 3 emissions, your financed emissions, if you will. Like, what are your scope 3 emissions at the moment? And they dwarf your operational emissions, as you probably know. And it's less about what your emissions are now, but how do you get them down? And as we come up with an intermediate target through Science-Based Target Initiative, it's going to be based on commitments companies are making. So if I go back to my example of that Midwestern utility, they're probably a huge carbon emitter, but if they have specific plans to reduce, to decommission their coal plants, they will show a very rapid trajectory of reducing their carbon emissions. And that's a really good thing. It's kind of good to have that company in your portfolio because it's going to really help you get to the targets you want. There are other industries where it's much more difficult to decarbonize, but they're going to need to. And if they don't have plans to, then they're going to show up as very bad in your target setting. And it's going to be hard to finance those kind of companies. But I would say in every sector, there are paths to getting there, and we want to be financing companies that are on that path. So what we try to avoid doing are exclusions, like saying, we won't invest in this sector or that sector. And again, I'll keep going back to my example, the Midwestern utility, that has a lot of their power generated by coal. Like, I think coal is the first place people go when they say, we're just not going to finance coal. And, I think in that case, it is a good thing to finance that company because they have a plan to get off of coal. If they don't, then for sure it's not a good thing. But so having exclusions, you paint everything with a broad brush, and that's not the case. What you want to do is support those companies in those sectors that are doing the right thing. And so, we try not to exclude any particular sectors.
It would be good to talk about your timber investments and how do they help you achieve the net zero target, right? And we have seen a couple of acquisitions by Manulife in the past year on timberland. So how do they fit into this ESG plan going forward?
Yeah. So timber is obviously a natural sink of carbon, right? Hopefully we'll get technology that'll sink carbon that's economic sometime, because I think we need that to get to our net zero in 2050. But in the meantime, like, timber is the best natural sink of carbon. And there's two parts to it. Normally when you made a timber investment in the past, it's, every investment is just the discounted back of the future cash flows. And it was based on cutting the timber, and selling the logs and what you could earn from that. And in a normal timber operation, you would plan to harvest, and but we like to do it sustainably. So we typically don't harvest more than growth. But what we do harvest, a lot of it goes into wood products that they're maybe not a permanent forever sink of carbon, but they are a sink of carbon for a long, long time. 2x4s that go into a house, that's going to hold that carbon there until that house burns up or something. So it's certainly, in my mind, helpful to get to net zero over the next period of time. And so we quantify that, and when we look at our operational emissions, if you will, and we look at how much carbon we sink through that process. So some of that stuff we harvest, by the way, is not, like, if because they're the trimmings that get burnt up or whatever, and that releases the carbon. But the stuff that goes into wood products is a sink. And when we calculate that, we are already, net negative in our operational emissions, if you will. But if you wanted to get like official carbon credits, that won't qualify, even though I do think it's a positive thing. We can talk about it in our sustainability report. I do think it is really helpful for the world getting to its commitments. But to get a true carbon credit, in a world where carbon credits have value, you need to have this concept of what's called additionality, which means you have to do something different. And we were kind of harvesting this stuff all along and putting it into wood products. So you're not doing something different to really help the situation going forward. So within the timber universe, what you can do is you can say, all right, I'm just not going to harvest. I would have harvested, but I'm not. And I'm just going to let it sit in the trees and let the trees continue to grow. And with that, and you have to get this certified, obviously, but with that, you can get official carbon credits. And so we started to make investments in that arena where we will take timber properties and say, all right, we're not going to harvest it. We're just going to sink it. And we will, look at, and that for that, you have to figure out, okay, how many carbon credits are you generating each year? What do you think the value of those carbon credits are? And, carbon credits don't have to get very high priced for it actually to be a better use of your timber than actually harvesting it. And so that's sort of where that space is going. I think people will value that as they start to make commitments and have to figure out how to get to their commitments. So I do think, we talk about this whole carbon world and where you have to be, where you have to be defensive and where you can be offensive. What are going to be winners in this space? It's easy to point out the losers. The winners, like timber, to me is one of the big winners in this environment.
And going back to your comment of the importance of investing in companies that has a real and concrete plan for decarbonization, and given the importance of energy, especially fossil fuels in Canada, so do you see a space for Manulife is still investing in some of these oil companies if they have the right trajectory going forward?
Yeah, as I said, we don't do exclusions, so we're not going to say we're not going to invest in a certain sector, and we certainly haven't been exiting certain sectors. And yes, we're a Canadian company. We invest a fair amount in the natural resource sector in Canada. And you need to pick your spots, like the Canadian oil sands, which you've seen many companies come out and say, they're not going to finance the Canadian oil sands. They're going to dispose of them because that is a higher carbon emitting space, if you will, the way they extract oil from the oil sands. But we look at what those companies are doing and what their plans are. And, in that space, it's actually very economic to extract that oil once all the capital investment has been made. And by and large, so if you're going to have a new project, it's very different than the existing project. Existing projects are very low cost to extract the oil. So they can stand expenses coming on them to either pay the carbon tax or hopefully better yet, figuring out a way to sink that carbon that they're emitting. And so, and they can better afford to do that than a traditional oil and gas driller. So, so it's very nuanced. You may look at Canadian oil sands, they emit more carbon, let's avoid them. But on the other hand, it's one of the lowest cost to produce. So they have the wherewithal and the ability, and we are seeing companies do that. So yeah, we continue to invest in this space. I would say, I do think oil is a transition fuel, right? Like when we get to 2050, I'm sure we'll still be producing oil, but a lot less of it than we are now. So that industry is going to have to transform itself, and we're probably a little more hesitant to make 30-year loans in that sector than we used to. I would say that. But it's not like we're avoiding this sector entirely, for sure.
So in this context, if you had to make a prediction about what Manulife alternative investment portfolio will look like in 10, 20 years, what would it be?
So our alternative asset portfolio is private equity, infrastructure, timber, ag, real estate, and oil and gas. Six categories. Oil and gas, we will be out of oil and gas. It's just not. It's in a secular decline. There's probably a lot of money to be made in it in the short run, but we're a very long-term focused investor. It's not where we want to be. There'll always be a place for real estate. It may evolve as to what particular subsectors. I think we really like infrastructure. We've been building up our infrastructure portfolio. Private equity will always have a place. It can't get too big. It's the highest returning expectation, but it's also the most volatile. Ag, I would like to increase ag. We haven't talked about ag with agriculture with respect to ESG, but it is also a sink of carbon, actually, which was a surprise to me. I figured, well, you grow corn, you cut it down, like maybe and you probably use energy to do all of that. It doesn't feel good, but actually, plants will sink carbon in the soil as they grow. So it's not like, so it can be a net sink of carbon, and we're very focused on that element of agriculture as well. And frankly, we're focused on doing more agriculture in Canada because we do think, as you think about global warming and extending the growing season in Canada, I think that's a tailwind for Canadian agriculture. So we've been pretty active in Alberta, actually, in the ag space. So I expect that to grow. We do think our all the portfolio, as you describe it, which is more, it's not an industry term, it's our own coin term for alternative long duration asset, as you said. We do think it's the right way to invest for at least a portion of our really long tail liabilities. It provides a higher return. We try to do it in a way to minimize the volatility. That portfolio is marked to market every quarter and run through our earnings, which can create, volatility in our earnings. So we try to keep that as low as possible. And we do, and we're obviously going to be very focused on it from a sustainable perspective. So I think, those investments that, help with the sustainability, timber and ag, those will probably grow. Those that are not that supportive, oil and gas, that's going to shrink and go away.
And Scott, as we are coming to an end for our session, and as we wait for questions from the audience, any final thoughts regarding your investment outlook for 2022?
Again, been through a lot of cycles. I think one thing I've learned, and I think we did a good job in the pandemic as an organization, and maybe not as good a job in the financial crisis, at least partially, is that you need to have risk budget to take advantage of opportunity when it comes along. And that can often be very hard to do, because when you get an environment when risk premiums are very skinny, and focusing on bonds for a minute, that means spreads are very tight. You probably want to take less risk in that environment. You're just not getting paid for it. But some others would argue, well, their spreads are tight because people don't see much risk, so that's fine. And oftentimes, and I saw this in the global financial crisis when I talked to my peers, is that oftentimes the investment groups get pressure to take more risk when spreads are tight, because you're not earning as much on those investments, and you kind of want to increase your earnings, so you need to take more risk to get spread at exactly the wrong time, right? When spreads are tight, in my opinion. So, to me, the lesson is when spreads are tight, and we entered this year with spreads have been widening out a bit so far this year, but we entered in a fairly tight spread environment, in my opinion, based on the uncertainties that lie ahead of us. So, you should keep some powder dry. You should have, or said another way, you should have some, you don't want to go all the way up to your risk limits everywhere. You want to have some ability, because when bad things happen, one, you'll passively take on risk. Credits will get downgraded. So as you measure risk goes up, that's going to happen. And you really want to be able to take advantage. And in my career, in the early 2000s, we had, the Enrons, the WorldComs fail, all that cycle. I was at John Hancock at the time, and we had all that pressure, and we were pretty full on risk budget. And so when bad things happened, we actually had to shed risk to stay within our risk budgets. And that was horrible. I never wanted to repeat that. As we went into the GFC, And this is actually where the ALDA was helpful, because the ALDA was producing really good returns leading up to the GFC. So there was less pressure to generate return out of our fixed income portfolio because that was doing so well. And we had a lot of risk budget. What I don't think we did as well as we could have is we didn't take advantage of it. We were nervous. We were not sure where things were going. We got very conservative and didn't do as much, didn't take on as much risk as we probably should have. I would say in the pandemic, again, leading into it, we had dry powder and we took advantage. I mean, I'm sure everyone on this call remembers in March of 2020, spreads just gapped out. And when I say take on more risk, it's not like, we were buying cruise companies, and even they were issuing at wide spreads, and that would have been a good thing to do because at least thus far they've survived. We weren't buying airline paper, that was getting really crushed, but you were seeing, our own industry issuing stuff at historic wides, and MetLife did a big issue at, I don't know, like 300 over, and you should just be taking, your safe government securities and rolling into, credits you think we're going to survive this at just unbelievable prices. Now, and markets snapped back very quickly. So maybe, we didn't, and probably was not prudent to use up all our dry powder in that short period of time because, bad things can continue to happen, but markets snap back very quickly. So I feel like we're positioned that way again. We have dry powder. Don't know that something bad is going to happen this year, but I'm concerned about the central banks making a mistake. It easily could. And we want to be just prepared to take advantage of that if that happens.
Thanks, Scott. So we only have one question from the audience so far, and it's in relation to the competition for talent in the financial services industry. So how Manulife is retaining and attracting investment professional in this environment where there seems to be a labor shortage, especially of skills professionals?
Yeah, and I don't think it's restricted to us. If we think it's bad here, I talk to my friends in technology, and it's just brutal there. But it's true everywhere. There's just such a war for talent, and it is a struggle. And the inflation rates we've seen, people expecting bigger pay raises. The war for talent, the war for diverse talent is even worse. It's everyone wants diversity, appropriately so. We want more diversity. And that's even tougher. So I'd say a few things. First of all, you have to pay competitively. But I always tell people in my group, if you want to maximize how much you're going to get paid next year, you probably should go somewhere else because there's always someone out there willing to pay you more. There just is. But if you want to get paid fairly and work at an organization you can feel good about, stick with us. So I think it's my responsibility to make sure the group is paid fairly, and that means we do market surveys and stuff and make sure, we're going to probably lag in the really go-go times like we're seeing now because it takes us a while to catch up. But people who come here for a career, and so people who've been here a long time, they understand that cycle. They like the culture here. They always talk about, what motivates people is not so much the pay, it's the culture, it's having purpose, it's having a career advancement opportunity, but they need to be, they need to believe they're being paid fairly, right? So that's, I feel like, our covenant with our employees. You need to pay people fairly over time. You're probably not going to pay them as much as someone across the street will pay them to move over there, but you want to create an engaging experience and, just look at the long tenor. I mean, I've obviously been here a long time. And as I was saying earlier, a lot of the people I work with have been here for a long time. They value the culture. And that's really what you have to do. So the most vulnerable are the people that have been here for a year or two. They've gotten some experience. Other people like that experience. They haven't been here long enough to really appreciate the culture and so forth. And that's where we're having the most difficulty. We did have some turnover there last year. So it's again, trying to communicate with those folks. And for them, I think they value, a real path to get ahead. So, you need to be able to show them a career track, and we spend a lot of time, trying to do that, creating development plans for those people so they know how they can get ahead. But but it's a challenge when someone across the street, will give them a 50% pay raise, which doesn't happen all the time, but it happens periodically, and it is hard to compete with.
We have another question, and is if you have any big picture regarding the Manulife corporate investments in Asia. I guess is more about what is your general feeling of the corporate bond market in Asia?
Yeah. So, as I said, every country is a little different. Every country has sort of a local public bond market, but they can be very small. I mentioned Vietnam. There is a corporate bond market there. It's very small. When people think of Asia and the corporate bond market, often they think of the Asian dollar bond market, which is a big market. I don't have the figures off the top of my head as to exactly how big, but it's big, and we have a big portfolio there. And they're big, and about half the issuance is out of China, which is often what gets questioned. Obviously, there's been disruption in China on a number of fronts. The biggest one is probably the real estate disruption we've seen. And so you have seen spreads widen out, certainly in that sector, but for China credit in general, spreads have widened out. I think they've snugged back a bit more recently. And I guess my thoughts are, just like everywhere, it's like you want to do your homework. You want to make sure you're investing in good credits. Even state-owned enterprises, they're not all, despite local rating agencies out in China who rate almost everything AAA, they're not, which I know DBRS would never do. They're not. You can have defaults there. Just because the government has an ownership doesn't mean they're immune to default. So you really, you need to do your homework, a lot of which is, reading through rating agency reports such as yours to better understand what's going on. So I think it's, the market's going to go through ups and downs as every market does, but I think it's an expanding market, and we remain positive on it long term, even though there are some short term uncertainties, and that's very sector specific, I would say.
Thanks, Scott. So we are at the top of the hour, so I think our session has come to an end, and I would like to thank you very much for your time today, Scott. It has been an interesting conversation about the investment outlook for Manulife and the life insurance industry in general here in Canada. So thanks again, and hope to see you soon again.
Well, thank you, Marcos. You've been a terrific host, and wish everyone a good day and good results in your portfolios.
Thanks, everybody.